Hello guys, thank you very much for joining in. We're going to be starting out with this chapter called as banks. Okay, from the exam perspective, please mention one question, okay, which is going to be theory based. So please write it at the top itself. Okay, the theory question is generally easy. Okay, majority of the time I've heard that the question are slightly easy from this chapter. Wherever I'm making star, wherever I'm underlining properly, okay, so I'll be highlighting those sections. Please make sure that you do it properly. Okay. Now, what is the intention of this chapter? The chapter has been added to give you the basic idea of how exactly financial market works. So this chapter, then the next chapter, insurance, then the fund management is basically to give the introduction. Okay, introduction about the bank. Now, a lot of people only understand bank from the retail perspective. Okay, so they start out with the introduction. What exactly is a bank? In US, banks are also called as depository institute because they are taking deposits. Okay, when you look at bank, okay, their major functions are divided as commercial bank, okay, or investment bank. Broadly, two things. Okay, when we talk about commercial bank, okay, they have two sections which basically connects to what kind of customers they are dealing with. So retail bank and wholesale bank. Okay. Now when we talk about retail bank, it is most driven by individual customers like you and me. So you go to bank for opening a saving account, for fixed deposit, for student loan, auto loan. So all of this will come into your retail bank. Okay. Plus there are a lot of small and medium enterprises who have business needs, but the needs are not very big. So retail bank itself, in lot of banking structure, retail bank will take care of it. Okay, but wholesale bank, when we talk about, they are generally, banks will have a categorization that above 100 crores it will go to the wholesale bank. Okay, so generally big corporates, their needs are very different. They will need help in issuing bonds. They will need help in their salary account for all their employees. Okay, making salary payments, so they need to have a big account, corporate account, current account for them. So their needs are very different. So wholesale banking is explicitly for corporates and other institution. Now, what is this institution? For example, LIC. LIC would need a bank account in HDFC. Okay, they would need a bank account at State Bank of India. So likewise, the wholesale banking division works. Apart from the bank account opening, they also provide letter of credit. They also provide line of credit. Okay, other services also which help them to do business. Okay, so that's the first paragraph, which is commercial bank, explicitly related to retail and wholesale. Let us go to this section, investment bank. Okay, now investment bank broadly do three activities. Okay, the first activity is advisory. Okay, when we talk about advisory, you must have heard about this merger and acquisition. Okay, so for example, Tata Group wants to do merger of wants to acquire a Land Rover, okay, Jaguar. So obviously they cannot do that on their own. Because first of all, when you're going to acquire the company, you need to do the valuation of the company, you need to check the legal aspect, you need to check the taxation aspect, and this is in a different country, UK. So how do we do that? So you will need an investment bank who has an expertise in all of this. Okay, advisory, which is explicitly connected to merger and acquisition, and lot of companies, they do restructuring. What is restructuring? I will close down one division, I will merge it with two divisions in one go. So I am running a business. I need expert opinion, okay, on making sure that how can I bring efficiency into my business. So a lot of investment banks, they also help in restructuring. Okay, restructuring the business. This is the first broader role. Second, they also help in raising capital. Okay. You must have heard about IPOs. What is IPO? Drishi, Harsh, Hitesh, क्या है IPO? What is IPO? You must have heard, na? Initial public offer. Perfect. Now think about this. DMart, first time going to public to raise money. First time, that's why initial. They need an expertise support in terms of at what price we should raise, okay, what are the SEBI requirements, at what should we do with our financial statements, what thing I have to submit, all of these. How do we do marketing? Okay, so for that you have investment bank, which is going to help them to raise money. That is correct. Raise capital through IPO. It is not only IPO. It can be FPO. What is FPO? Have you heard of this? Abhiram, Amit, Anand. क्या है? Follow on offer. That means I have already sold shares to company investors. Now I want to sell more shares. Okay, so that is a follow on offer. You can also go and do bond issuance. Now think about this. Reliance wants to raise money, okay, through bonds in US dollar in US market. Okay, so over there you need support. You need support to help and understand what market it is, what should be the raising requirement, what are the Federal Reserve's requirement, all of this, SEC requirement. So you help them to manage that. Okay, bond issuance, okay, explicitly into countries. So there is, for example, Mitsubishi Bank. Okay, they help Japanese companies to raise money in India. Okay, somebody talked about private placement. What is private placement? I am selling shares of my company, not in public. I am selling it privately. Okay, so it is nothing but Flipkart selling shares to some investor. That is what it is. Okay, I hope everybody is able to hear me properly. सबको मेरी आवाज आ रही है, right? If anybody is facing an issue, kindly rejoin once. Now is it visible? Now is it audible? Now the voice should be clear. Okay. Okay. So we talked about advisory, we talked about raising capital. Okay. And I hope everybody is good till that raising capital. Third point is sales and trading. Now what is sales and trading? So for example, if there is an institutional investor, for example LIC, they want to buy stocks of big company, say Apple in US market, or they want to buy stocks, for example, institutional investor, not retail investors. Okay, they can go to an investment bank, they can call up the investment bank. Obviously they need to have an account. Okay, they can call up the investment bank, that their trader will pick up the call, he will take the order, he will execute the order fast and in a very efficient way. Okay, so they generally provide service in such a way that if your transaction volume is so huge, they will be able to do the transaction without impacting the price. So they have systems in place for that. Okay, so and they charge a commission for helping you to do the transaction. Basically brokerage, okay, or commission for institutional investors. Okay, so these are the broader three activities that they do. Majority of the time when you hear about investment bank, you will only hear about this, advisory. But in reality, most of the activities that they do is the sales and trading. Okay, let us go back. Now they have talked about a bank or a bank holding company. Okay, what is a bank holding company? For example, I might have a HDFC bank holding company under which I might have a lot of entities. Say for example, I might have HDFC Bank. Okay, previously there was HDFC Limited, which was only giving home loans. They had HBD, right? So parent company, and within that they have lot of other companies. Okay, so either it can be a bank or a bank holding company. Okay, bank holding company, that is the reference. Let us move forward. Okay, so they can engage into commercial banking, investment banking, or must only do one or two depending upon what is the regulation. So in US, a lot of states might have a regulation that okay, you can enter into commercial or investment both. In certain state, it might be like you can only enter into one. So what is a local regulation? They have to follow and they have to comply. Now, this is not very important. This is just to give you a view. Okay. I am moving ahead. I hope everybody is with me. I am purposely going slow. Okay. Major risk which is faced by the bank. Okay. Mark this as star. Credit risk. Okay. And this is the main risk of the bank. How do we say that? That it is the main risk of the bank. So, this is bank is standing over here. Okay. Depositors. They basically come to bank and they put money. Okay. And let us assume that they have, this is the cost of fund. Okay. Because for depositors, you have to give some rate of interest. Let us assume we are giving 3% rate of interest. And what bank is going to do is, they will give loans or they will make investment. Okay. And they will try to earn, say for example, 7%. Okay. This is the return on the investment. Okay. This is my liability side. This is my asset side. Okay. Because to the depositors, I still have to pay back. Okay. Now, what is the credit risk over here? If suppose tomorrow this loan turned out to be bad, this investment turned out to be bad, I still have to pay the depositor. There is a credit risk which I am facing, that I might not have the sufficient amount of money to pay back, because wherever I had given loans, those customers are turning back. Okay. That is a pure credit risk. So, from the banking perspective, there is a risk that the borrower will not be able to pay back. Okay. Now, banks, international banks, they don't even just give loans. They also enter into derivative transaction. Now, we have not touched in detail the derivative. It is going to come in the next sections also, next few chapters. But derivative, you have to think it this way. Suppose I've entered into a forward contract, okay, or swaps, where the risk can be very high. Okay. For example, and I'm just slightly deviating. So, do not worry. This example is not specific to this chapter. Okay. It is just to give you an understanding. Suppose there are two companies. There is Ganesh, okay, and suppose Dipti. Two companies doing the transaction. Ganesh said that I will pay you 5% per annum. Dipti said that I will give you LIBOR. Okay, LIBOR percentage. This is a floating rate. Okay, I hope everybody knows LIBOR, London Interbank Offer Rate. Okay, this is a market reference rate which is used in the contract. Okay. Now, this contract is for say 3 years and the notional principal of the contract is $100 million. Now, this notional principal is only used to do the calculation. Okay. Now, what happens? Suppose we sign the contract on this date. Every day LIBOR is calculated. So, let us assume on this date, at time 0, the 1 year LIBOR rate was say around 7%. So, what will happen when we reach over here at time 1? Okay, Ganesh is supposed to pay 5%, Dipti is supposed to pay 7%. Okay, so who is going to pay now? You'll have to net, and then who is going to pay? Dipti will pay how much? 2%. 2% of $100 million. That is $2 million. Okay, so now I am writing from Ganesh perspective. So Ganesh will get $2 million. But let us assume that when we reach at time 1, okay, from here till here, the LIBOR rate was 2% only. So now what is going to happen? Ganesh will pay 5%. Ganesh will receive only 2%. So net mein Ganesh is going to pay 3%. 3% into $100 million, $3 million. So do you realize at one point in time I was in positive in the trade, at other point I was in negative. Okay, now concern comes, credit risk comes. Okay, if I am in positive, I am expecting some money from Dipti and she collapsed, basically bankrupt. He is bankrupt now. So I am facing a credit risk. I hope everybody is clear. Right? Okay, so my counterparty is negative, I am in positive. Then only I am facing a credit risk. Very simple. Okay, so banks do engage into a lot of derivative transaction. In derivative transaction, LIBOR is nothing but Hussein, London Interbank Offer Rate. Every single day you can check what is the LIBOR rate for 1 month, 6 months, 1 year. You can go and use that in your transaction. Okay, I'm moving forward. Trading of derivative. Okay, so when you enter into derivative transaction, okay, please also understand these concepts are going to come in detail in later part. So don't try to understand the concept entirely now. See, FRM curriculum is not very structured. So they are not doing like this, that first we will teach you derivative and then only we'll give you the content. It is not like that. Okay. So I am trying to give you a gist only to help you understand this section. Okay. Real content will come when we move to the derivative chapters. Okay. Now, so when banks do trade in the derivative, so we talked about credit risk. What is the credit risk? I am having a positive, positive value in the transaction, and I am afraid that my counterparty will default. Okay. In a lot of transactions, you also face market risk. Okay. What is a market risk? If I go back to example like this, what is my market risk? If suppose this LIBOR rate goes down, then I will have to pay in the transaction. This is what happened over here. That is a market interest rate went against me as per the transaction. It went down. So I am going to get very low rate. Okay. And I have to still pay 5%. That is a market risk. That the interest rate went against me. This is with respect to derivative transaction. Okay. But when I talk about retail bank, see, this example is only pertinent to retail bank. Okay. Let us assume that bank, I'll go back over here. Okay. Bank is basically paying 3% to depositor. Okay. And they are getting 7% on an average from the customer. So what is the spread that they are making? 4%. What is the spread? 4%. Now in that 4%, I'm going to write that over here. 4% is the differential spread that they are actually making. Okay. 4% is the differential spread which they are actually making. In the book example, they have taken 2%. Okay. What is that difference? Difference the interest rate that they are charging and the cost of fund. The interest rate they are charging to the customer and the cost of fund, that means what they are giving to the depositor. Okay. From that you have to remove. Suppose this 4% is my spread. From this, I am going to first remove, say, around 2% my expected loss. What is my expected loss? When I enter into any business, on an average, I know this is the loss I am going to face. So I have to remove this and I have to keep it aside. Okay. Out of that remaining 2%, okay, suppose 1% is my cost of running the business. Then the remaining 1% is my profit. Okay. And if you read this section, that is what they are highlighting. Any query till this point? If not, then give me a quick confirmation on chat. Okay. What is the market risk that the bank is facing? Now let us assume, okay, that bank had roughly $100 million available, okay, which they were planning to invest. Okay. So they might be buying treasury bond, government bonds. They might be buying corporate bonds. Okay. Now when I'm buying all of this, whenever I'm making an investment, if the value of the investment goes down, why? Because there is some negative news about the country, Federal Reserve has increased the interest rate, okay, FX rate has jumped, GDP has gone down, the market forces, okay, because of which the price of the security has declined. So what is the problem? Okay, see, all of these macroeconomic variables, examples are interest rate, exchange, all of these. If it goes down, I am facing a loss. Okay. And that is going to be an impact. Okay. Now they have used a word called as market maker. Okay. Now, if you I want you to read properly. Okay. In a lot of transactions from here to here, in a lot of financial contracts, bank act as a market maker. In those instances, bank is controlled exposure to market effect. Now, for this, you'll have to look at this example, very simple example. But if you miss, I will not be repeating this. Please focus. Okay. Let us assume. I'm going back to the example of Ganesh and Dipti. Okay. Two companies. Okay. Now, ideally, what will happen? Ganesh and Dipti, they will not be able to talk to each other. Because if I want to enter into a transaction, I don't know exactly, okay, this company has to enter into exactly opposite transaction. Very difficult to know. So what ideally will happen, there will be a financial institution, say for example, JP Morgan, who will sit in between, okay, and he will become your counterparty. For Ganesh, now this is the counterparty. For Dipti, it is the counterparty. Okay. Now, what financial institution will ideally do? Okay, suppose I'm taking a very simple example. Okay, Ganesh has taken a long position. Long means what? What is long? Purchased. I've taken a buy situation. Okay, so financial institution will become my short. That means my counterparty, short position. Very simple. If Dipti has taken a short position, financial institution will become a long. So do you realize this institution is sitting in between, okay, trying to take exactly opposite position. Okay, when you are buying and when you are selling, you will try to structure the deal in such a way that if I am selling something at say $100, I am going to buy over here also at $100. So what will happen if the price goes up? Think, if the price goes to 120, what will happen? Over here there is going to be $20 profit, $20 loss, zero effect. If the price goes down to 70, over here $30 loss, $30 profit, negative, no impact. So in certain transactions where I'm sitting in between as a market maker, where I'm taking both the position, I have no effect of market price moving up and down. So there is no market risk in that. So if you read this, they are saying the same thing. Read this section fast. Financial institutions work as brokers. Yes, they also work as brokers, but they don't work on their own. They have different entities, different companies. If anybody is facing an internet issue, please rejoin. Please rejoin. Okay. I am moving ahead. Operational risk. I am moving ahead. Operational risk. Okay. Now over here, what is operational risk? Please write it down. People, process, external event, and system. And system. People, process, external event, and system. Okay, so what is this? Every company which is operating in the market, be it bank, insurance, financial institution, anybody, they face these risks. That what is people specific risk? People will make mistake, errors, people will do fraud. What is process related problems? You have not designed the process properly, and because of which you make mistakes. Okay, there is no problem with people, but process itself was not designed properly. Okay, you are sending money to your vendor, but you are not checking which account it is sending. It is not written, so nobody is checking. Correct? What is external event? It can be cyber attack, it can be earthquake. Okay, because of which you are not able to come to office, you are not able to perform your duties, and that is leading to a loss. Okay, and finally, system. System means your servers are not working, your IT systems are not working. All of this would lead to your operational risk related part. Okay. Kindly read that paragraph, operational risk. I hope everybody is good. People making mistake, more or less. See, that is just an example. Okay, it can be any other example. It doesn't matter. This is economic capital and regulatory capital. That is what you need to now focus on. Okay, now why, when companies basically they invest, okay, they take positions, they are facing risk. Okay, so now when you're giving loans, when you're entering into any transaction, you're facing a lot of risk. So you need to have sufficient level of capital to protect themselves. Now, how do you generate capital? You can either take equity. Equity means stock. You can give stocks and get money. Okay. So generally companies have equity which is there to maintain solvency. Solvency means they have enough money to sustain. They have enough assets to pay the liability. Okay, this is one way. You can either issue equity or you can either issue debt. Long-term debt, 10 years, 15 years, 30 years debt. Okay, so that these ways you have some capital available which can help you to protect if there is tomorrow a challenge. Okay, so if there is tomorrow a challenge. Okay, bank may also, the debt is subordinated to the claim of depositors. Mark this line as star. What is this? Bank is subordinated. Okay, so suppose tomorrow I'm talking about HDFC Bank. Okay, now HDFC Bank is, for example, has already issued a bond A, and they also have equity which is shareholders. Okay, and suppose, let us assume tomorrow there is a financial distress on the bank, and bank is going to get liquidated. It's failing. So the first responsibility will be to pay the depositors. So these bonds will be subordinated. Subordinated means below the depositors. First, you will pay the depositor, and then if the money is left, then you will pay the depositor, and then if then you will pay the bondholders, and then if the money is left, then you will pay to the equity holder. Ye clear hai? Right? I hope everybody is clear on the first part. Okay. Equity capital is generally concerned as going concern, and debt is generally concerned as gone concern. Because when you raise generally debt, okay, to cover the losses, if tomorrow you are going to face any operational risk event, credit risk event, anything big, okay, then you are facing a loss. Okay, so you generally raise debt to manage those losses, okay, to cover those losses. Okay, but you raise equity to run the business, okay, to operate the business. So you basically take shareholders' money because you want to use that money to generate assets, and you have to run the business that you are actually in. Okay, for a bank, the business means you are taking depositors' money and you are issuing loan, but you need equity also, shareholders also, okay, who are the owners of the company. Okay, so basically they've just bifurcated that, okay, equity is called as going concern because it is used, the money is used to operate the bank, operate the company, and debt is called as gone concern because it is basically used to cover the losses. That name has been given. What is regulatory capital and what is economic capital? See, concept is very simple. So have you heard about Basel norms? Anybody heard about Basel norms? Apurva, Bhaskar, Divya, yes, Kamal. What is Basel norm? So regulator is saying, so Basel is a global regulation. Okay, so now India RBI is saying we will follow Basel. So regulatory capital is nothing but regulator is saying everybody, every bank in India, they have to follow this much amount of rule, and because of this regulatory rule, you have to calculate the capital, and this is the minimum amount of money you have to keep. Okay, so you have to follow the Basel rules, and in that rule there are rules for operation risk capital, credit risk capital, liquidity capital, everything. And you have to calculate the capital, you have to keep money, different amount of capital in bank. Okay, but what is economic capital? It is my own assessment. So bank is running its own model, because obviously bank will if I am the MD of the bank, I will understand more better what is happening in the bank rather than the regulator, ideally. So I will create my own models, okay, to understand what is the true nature of risk. Okay, that is nothing but economic capital. Okay, so I am calculating risk for my own self. Okay, own self. And why do we need this capital? Because we want to cover the unexpected loss. Unexpected loss. For example, okay, for example, this is the negative side, this is the positive. Okay, when we talk about, okay, the loss side, expected losses, we know on an average this is going to be my loss on an average. Okay, so let us assume this is $100. But unexpected loss is, suppose, loss going up to $1 million. So I need some capital to protect me for that worst situation. That is where the capital, economic capital, regulatory capital is going to help you. Now, answering to the query, is economic capital always higher than regulatory capital? Not necessarily. See, regulatory capital is, the process of calculating regulatory capital is more or less same for everybody. But suppose your bank is more proactive and they are not taking much risk. So your economic capital is going to be lower. Okay, your economic capital is going to be lower. Okay. So I've completed till this point. Any query till this section? Basal and regulatory capital is same? Yes. So ideally you are supposed to maintain the Basel regulation or capital that is expected by the regulator. Okay. Now Basel as a committee, okay, they have a committee in which basically come out with Basel 2, 2.5, 3. Okay, so they are setting rules. Okay, basis that the banks are expected to keep capital. Now, why are they expected to keep capital? Because they are entering into loans, they are entering into derivative transaction, and they face a lot of risk, credit risk and all. So when initially Basel was introduced, okay, they had only kept capital for credit risk. Okay, so they thought that bank only face credit risk, but over a period of time, when they entered into Basel 2, 2.5, they realized that bank also face operational and market risk. So now the capital requirement is very huge. They have to keep capital for credit, market, operation, liquidity also. Okay, liquidity also. Now over here, models are used to calculate regulatory capital. Models in the sense that you have set rules. Okay, and as per that you have to create the model, and as per that you have to run the model. Now, when we talk about Basel norms, again, all of this will come in detail in level 2. It is not expected that you will know what was the standardized model in credit risk. No, it is not expected. They are just giving you an introduction. Okay, next part. What is the standardized model? And also when initially the Basel norms were created up to Basel 2, okay, under credit, under market, okay, they had given, okay, some freedom. Okay, so there was one standardization, standardized model, standardized approach of calculating capital, and there was some internal rating based approach. Okay, IRB approach. Okay, it was advanced IRB, foundation IRB, all of that. Yes. Okay, so in internal rating based approach, there is more freedom. I am giving a very basic structure. More freedom to banks to choose the parameters in the model. Okay, so initially lot of banks, they were using this. This is the part of Basel. Huh? I am talking about explicitly credit risk. Okay, so Basel may, they had this, most of the banks were using this internal rating based approach, in which they will follow the rules given by Basel, but somewhere they had some freedom. And because of which, what happened? Lot of these models which the banks had created to calculate capital. Again, this I'm still talking about regulatory capital. Huh? Okay, these models were very unique. Okay, and the regulator realized over a period of time that we are not in a position to compare. So when I go to ICICI Bank and I check their regulatory model, when I go to HDFC Bank, the models are very different because as per internal rating model, they had some lot of freedom. So the regulator started asking banks that, okay, you have to move towards standardized, where everybody will follow a same structure. Okay, everybody will follow a same structure. Okay, so standardized model is more better because you can compare. Okay, you can compare. If you read this entire part, okay, internal models developed by the bank, we talked about this. After the crisis of 2007 and 9, they said, no, do not use internal model, move to standardized. Move to standardized for calculating all of this. Standardized means I will give you set of rules. You do not have to do anything on your own. You just have to calculate it. Again, if Basel has to be implemented in India, who is our national regulator? RBI. They will have to approve. Okay, they will implement Basel norms over here. Okay, but if suppose RBI says that okay, HDFC you can calculate internal also, there is no problem. Okay, then it is okay. It is all up to the national regulator. If they allow a bank, then it is okay. I'm taking a pause over here. Any query till this point? They do allow, the next point is connected to that. This they do allow internal rating model, but they are asking, they are keeping a floor, which I'm going to talk now. Okay. Now let us go to this last section. I want you guys to mark this. Now the concept is very simple. Like I said, okay, lot of regulators, they allow banks to have their internal model. Okay, so internal model, and this is my standardized model. Standardized model means everything is set by the bank. Okay, let us assume that the capital calculation as per standard model is $100, and the capital calculation as per internal model is only 40, and this will happen most of the time. Why? Because generally banks, when they are creating these internal models, they have freedom on what parameters should be chosen. Okay, say for example, in a credit risk, you have to choose probability of default. Okay, if I'm going to increase my probability of default, the capital will be bigger. Okay, but if I do not want to keep high capital, what I will do, I will reduce the probability of default. Logical? So, why bank doesn't want to keep capital? Because if I will have to keep capital, the money is stuck. I cannot give loans using that money. It's a cost for me. So, a lot of banks would ideally prefer to keep very low capital. But regulator is saying this. Okay, if you're calculating as per internal model also, if you're using internal model, regulator is saying you need to also calculate as per standard, and whatever is the number coming out of the standard model, okay, thus 72.5% of that is 72.5% of $100, that becomes $72.5. Okay, you cannot, this becomes your floor. You cannot keep capital lower than this. Even if you're getting 40, I don't care. Keep 72.5 minimum. If suppose you would have calculated capital as per internal model and you would have got 80, then you have to keep 80. But minimum it should be 72.5. I hope everybody is clear. Harsh, Khush, Kirtam, Sadik, clear? Universe. Very basic, very simple concept. Why lower capital is preferred? Because if you keep lower capital, bank can use that money to give loans and earn extra return. So they will never prefer to have good amount of capital. But regulator is saying, please put capital. Okay, because if you do not put capital, the risk is going to be on the bank and bank will fall. Okay, now the next section. When the 2007 and 9 crisis came, okay, lot of banks were solvent, but they were not liquid. What does that mean? Okay, So when we talk about solvency, okay, it basically means in my books, do I have asset greater than my liability? If it is there, then I'm solvent. But it does not mean I'm liquid. Suppose I have an asset which is a real estate property. I want capital right now. I need money right now. I need liquidity right now. I cannot sell the property immediately. So assets can be illiquid. Okay, so on paper your bank might seem solvent, but liquidity is not there. Liquidity is not there, and that is going to create a huge problem. Okay, that is going to create, and that is why regulator Basel said that after the crisis they changed the regulation and they said for liquidity specific you need to calculate two things: liquidity coverage ratio and net stable funding ratio, which we are actually looking in the book. Okay, what is liquidity coverage ratio? They are basically saying, think that for the next 30 days there is huge outflow from your bank. Then do you have good amount of high quality asset? What is high quality asset? Government security. Do you have that so that you can sell and pay back that amount? Okay, so if tomorrow there is a continuous 30 days financial stress, will you have enough money available, enough capital available, or high quality asset available? This is the first ratio. Again, for the exam, you don't need to remember what is the formula and all of that. Okay? Net stable funding ratio is, it basically means this. What is the available funding divided by what is the required funding? What is the available funding and what is the required funding? Okay, so you have to take care it in that manner. Okay, so available funding and required funding. Okay, so if your numerator is bigger, then automatically you will end up making, you have good amount of source of funding available to, as compared to the required one. So you are more or less liquid. So banks have to calculate these ratios continuously, because if there is a mismatch between your asset and liability, okay, especially your maturity mismatch, then you will end up facing low liquidity situation and you might fail. Okay, I'm taking a pause reading till this section. One more point guys, do not log in from two devices. Automatically in the next few minutes it will get logged out. Then don't send me message. Okay, please do not log in from two devices. Okay, chalo. Answering to the query, Dukmani, does bank lose credibility if they use economic capital in front of public as they are seeing less capital? No. See, if your economic capital is 100 and your regulatory capital is 200, you have to keep 200 only, because you are then breaching the regulatory requirement. That is not correct. Okay, Vishnu, answering to your query, is the required funding means cash outflow? For any reason you need money, any reason. So people will take loan from you. You have to keep some money for depositors. They are withdrawing. They are also going to withdraw some money. Na? People will give check. People will issue NEFT. You need capital. All good? I've answered your queries. Okay. Now, deposit insurance. Have you heard about this? Do we have deposit insurance in India? Till what level? What is the amount? Shruti, Somdatta, Sahil, Pratik, 5 lakhs. Previously it was very low, now it is 5 lakhs. What is this? So banks, regulator is saying that you have to make sure, banks will have to take deposit insurance. That means they will have to go to insurance company and say, I am going to pay you premium, but if I fail, my depositor should get up to 5 lakh rupees, minimum 5 lakh rupees. Okay, suppose if I am having 60 lakhs in bank, minimum 5 lakh I will get if the bank collapses. Okay, yes, DICGC. Okay, so this deposit insurance is very, very important. Okay, because this gives guarantee It is valid to all the banks under RBI. They have to take insurance, or else they cannot operate. And why do we need? Because if tomorrow there is a run on the bank, see, when the depositors are afraid that if this bank is not stable, how will we perform? Okay, so to prevent run on the bank, okay, the regulator generally asks you to have deposit insurance. Okay, so, and who is going to pay the premium? Bank is going to pay the premium. To whom? Insurance company. Okay, now there is a very big problem which can get tested in the exam, which is moral hazard. Okay, now I'll explain you in a simple language what is moral hazard. Suppose I have taken life insurance. Post life insurance is approved. I am doing scuba diving, skydiving, because I'm okay. If tomorrow anything happens to me, my family will get the money. That is moral hazard. So your behavior changes after you get the insurance. You start taking higher risk. Okay, that is moral hazard. Now the problem is, if banks are going to take deposit insurance, they know my depositors are protected up to 5 lakh. So they can take risky bets. This is the first problem. Banks will take risky loans, give risky loans, enter into risky transaction. Second, the depositors, before putting their money into any bank, they are not even going to think that whether the bank is actually good enough or not, because they know there is an insurance available. Right? So moral hazard from both. So depositors will pay very less interest. Okay, and it can end up, banks will end up taking higher risk. Okay, they will end up giving higher risky loans. Okay, that is a problem of moral hazard which is there. Okay, but how do we resolve this? So every year the insurance companies will do audit of the bank, and they will do risk-based premium. If your risk is going up, your premium will also go up. Okay, and this has been added because a lot of banks actually failed in US during that period of time. So how do we resolve this? This part is important. How do we resolve? We basically ask for risk-based premium. If you are poorly capitalized, what is poorly capitalized? You are not keeping capital as per the requirement. So you are poorly capitalized. That means you are higher risk. Your premium will be also higher. If you are a well capitalized bank, your premium will be lower. Okay. Read till this point, and then we'll move ahead. What is the time frame of getting the insurance? The banks, it is continuously, it is already there. No? If you're getting a banking license, you have to have an insurance. I hope I've answered the query. Apurva, I've answered. Hitesh, what is investment banking financing arrangement? Okay, investment banking financing arrangement. See, when an investment bank, okay, see, we said investment banks can help companies to raise money. So they can sell securities also, right? Okay, so over here, arrange a security issuance for the customer. That means if tomorrow Asian Paints, okay, they want to raise, they want to do a follow-on offer, share. They will go to investment bank, and these investment bank will help them to sell their share in the market. Okay, so they will, either they can sell the entire share to some mutual funds or some pension fund, that can be also possible. Okay, or they can directly do it in public market. So that bifurcation is not over there. What is private placement? Okay, there are a lot of qualified investors. Like for example, Rakesh Jhunjhunwala is a qualified investor. Everybody cannot be. You need to have a net worth in the market. Then only you can enter into private placement. Okay, if you are a qualified investor. Okay, and what happens in this? You don't go to public. You go to only selected few people. They invest money into your company. For example, Mark Zuckerberg is buying shares of the Reliance. That is a private transaction happening. Okay, there are investors who have sufficient wealth and knowledge. Any startup, when they are selling their shares, it is basically happening through private placement because they are not listed, right? Now, when this happens, investment banks will earn a fees. So basically, they are going to say Byju's that, okay, I will help you raise $1 billion, but I will need $10 million after that. Okay, so that is the fees that I'm going to charge. That is private placement in a group. Okay, but the moment you go to public, because you want to raise bigger amount, then you have to do public offering. Okay, that IPO is a part of that. Okay, public offering mein IPO is a part of that. But when the institution or the investment bank is going to help them, mark this as star. Okay, investment bank is going to help the company to raise money. It can happen in two ways: firm commitment or best effort. Now, what is firm commitment? Very simple. Okay, so I'll help you with the first best effort. So suppose DMart comes and says that I want to raise money, okay, 5,000 crore rupees from the IPO, and they go to some investment bank, say JP Morgan or Goldman Sachs. Okay, now what is going to happen? The Goldman Sachs, suppose it goes with best effort. Okay, so they will basically help the company to market. They will do the entire analysis, they will provide their services, and they will help to market the company. But if suppose the market people or participants are not interested in buying, then they will not make any tension. The investment bank will charge a fees for the services that they are providing. Okay, if there is, have you heard about IPO being oversubscribed, undersubscribed? Oversubscribed means there were 100 shares, for example, and the people who have requested are more than that. So 25 times, 10 times oversubscribed. That's why there is a huge demand. Zomato, DMart, right? So what happens is when you are going for a best effort, an investment bank is not obliged to make sure that you will get the entire 5,000 crore rupees. Okay, they will only help you whatever is possible, and they will earn a fees income for its service. But when we go for firm commitment, what happens? Investment bank is saying, I will try to, generally what investment banks generally do is, if the company is smaller, I will purchase the entire share from you, and then I will sell it in the market. Okay, so they will negotiate. So because of this, what happens? The issuer is not facing any risk, because he knows short I'm going to get 5,000 crore because the investment bank is helping me. He is giving a firm commitment. Okay, so generally these banks, they give a commitment that we will give you 5,000 crore rupees. We'll take the share, we will sell it at a slightly higher price, and then we will make profit. So we will sell at a slightly higher price. That means we will be able to earn some spread, okay, above the price. So suppose I purchased one stock. I purchased one stock at 5 rupees. Now I am selling it at 7 rupees. That is a profit, $2 profit that I am going to earn. Okay, I am taking a small pause, asking you guys to read. How do we know if the IPO is on firm commitment or best effort? You will have to read the offer document. Na? IPO offer document. If you first time go to the market to raise money, it is called as initial public offer. Okay, and when you do IPO, you also have to list your stock. Now, why do we need listing? You list on your NSE, BSE. Why do we do listing? Devika, I can share the link if you want. Practical application thoda difficult hai, but I can share the link if there is an online material available. Okay. I was talking about IPO. So when you issue an IPO, you also have to list. You also have to list the stock on the NSE, BSE. Why? Yes, suppose I have purchased DMart stock. If DMart is not listed anywhere, I cannot sell it to any other investor if I want to sell it in the future, right? So people who have purchased the initial share, if they want to sell, there has to be market. That is why it is listed. Okay. Now, when you do initial public offer, the company is not trading till that time. So it is very difficult to analyze the company. That is where investment banks come into this, because they are expert in analyzing, do the valuation of the company. So they have an expertise knowledge, and they will help you to do the entire valuation, cleaning the books, and then they will do it. Okay, that is the IPO, very basic information. Dutch auction process is very simple. Okay, Dutch auction process is very simple. Let me give you an example. Okay, suppose there is Apple which wants to do IPO. Okay, and Apple has 150 shares available, and it is following a Dutch auction process. And when the IPO was initiated, okay, you give time for people to send an application. Okay, let us assume there was A, B, C, D, and E. These many people who had issued, who had shown interest in buying the Apple share. And generally, what we do, we give a price range. Okay, let us assume the price range was $10 to $25 per share. Okay, now as an investor, you can put any number between this range, whatever you feel is the right number as per your analysis. Okay, suppose A is asking number of shares. Now I'm talking about number of shares that he is asking, and what is the price that he is quoting. So A said that I can buy at $20, okay, but I need 30 shares. B said I need 20 shares, but the price is $15. He said that okay, I can pay $22, but I need only 7 shares. Okay, likewise. Okay, D is saying that I can buy 70 shares, but I can only pay $15. Okay, E is saying I can buy around 50 shares, okay, at $19. Okay, so like this, and suppose if there is G also, there is one more person who is saying I can also buy 50 shares at a price of $21. Okay, now if we are following a Dutch auction process, okay, which we will go to the highest bidder. Who is the highest bidder in this case? C. Okay, so first we will allocate 7 shares to C. Okay, next, who is the second highest? G. G 21. So we will give 50 shares to G. We are still left with a lot of shares. Okay, and then you have A, right now? A. So we will give around 30 shares to A. Okay, so we are done with G, we are done with C, we are done with A. Now after A, who is the next best? Okay, E, right? So we will have to give E roughly how much? 50 shares. So do we have anything left? We are 137. We have 13 left. 13. I'm just going to put over here, right? 13 left because we had only 150 shares. Right now, after E, who is left? Who is the next lowest? See, over here, we have this and this both. Okay, 15, 15. And both of them are asking for 20 and 17. What generally we would do is, we will split this. Okay, so we will, and now this is an odd number. We will have to give somebody an extra share. Okay, so it can be B, it can be D. Okay, 6 and 7, for example. Okay, what the quantity? It can be, yes. So that's the reason I have given higher number to this guy, D. Okay, so that's the reason we gave him 7 shares. Okay, and see, it depends upon what is the rule being set. In a lot of cases, like Anand is saying, if there is a match, whoever is asking the higher amount, I will give it to him. It all depends upon what is the rule that I have set. Now, in my example, I am deciding I will be giving equal. I hope Anand, you are clear. No, Anand, you are wrong. When I am starting out, I will only start with the highest price. Yes. Okay, so I hope everybody is okay. So we have allocated 150 shares. Now, what was the last price in which we have given the share? What is the last price? 15, no? That becomes your offer price. This is the price that everybody will pay. This is the price that everybody will pay. I want everybody to read this section. Kindly read this section. Poison pill, why are you asking? This is not there, no? If it is going to come later, we'll explain. Don't worry. Let us move forward. अमित पूरा वापस नहीं बता पाऊंगा, टाइम चला जाएगा. You'll have to watch the recording. Shall we move ahead? I have purposely underlined this, huh? Richa, Pooja, Swapna, Ahir, Vishal, Tejas. Potential conflict of interest. Now, what is potential conflict of interest? See, banks, especially investment banks, they get lot of information, and there is a very good chance, okay, that you can have material non-public information and you might misuse it. Okay, so if a bank or a bank holding company which provides all of these services, commercial banking, investment banking, and security, there is a very good chance of conflict of interest. Look at the example and understand the problem. Huh? That is more important. Okay, look at the first example. Now, suppose I have Kotak Investment Bank. Okay, and I also have Kotak Securities. Okay, suppose DMart comes to me. Okay, please help me in raising money through IPO. This is my client. Okay, if there is no rules and regulation in place, what will happen? Kotak Investment Bank will call up Kotak Securities and say to call all the customers of yours and start aggressively pitching DMart. Because I am doing the IPO, no? So there has to be, this is a conflict of interest. That investment banking team can call up Kotak Securities and ask them to pitch for the product because we are coming out with an IPO. Okay, that means we want to generate that what do you say, excitement in the market, or we want to pitch to customers that this IPO is going to come, please put money, like that. Okay, so this is a one conflict of interest. Second would be, I can ask Kotak Securities, for example, they have research analysts which will come out with report. I can ask them to send a report or generate a report which is by recommendation, which gives a lot of good picture about DMart. Okay, a lot of good picture to the DMart. So this is a problem. This is the conflict of interest. So when there is a pressure, especially on people who are working in the securities business, that they have to forcefully sell to the customer or they have to give buy recommendation, then what is going to happen? There will be no independence and objectivity. There will be no independence and objectivity. Okay, so they will not be able to perform their duties properly. Read this section and let me know if there is any challenge. What is objectivity? If anybody is going to take a decision that buy recommendation is there, you need to have a logical answer to that. Not because somebody is saying, no, it is not objective. Next example, look at this. What is the next example? If there is a banking department, okay, especially the commercial banking, they get a lot of information because suppose you are working for Yes Bank into their commercial banking division and Asian Paint is coming to take a loan. So they will give you a lot of information about their company, which project they are going to start. So when they are negotiating loan, or arranging some security issues, you get a lot of material non-public information, something which is not available with the public. Now think about this. If your commercial banking division informs investment banking division that okay, this information is very good, the stock price will go up, then automatically they will make profit, right? So they will get unfair advantage. So there has to be some way we can stop this, or else there is a clear-cut conflict of interest. I hope everybody got the example. If Asian Paint comes and tells that we are going to get an order from government, okay, and this news is not out, if I give this information to my trading team, they can buy Asian Paint stock. And what will happen? When the news comes out, the price will go up and they'll make profit. This is wrong. The second example. So because of all of these conflict that is there, inherent, what banks generally do is they create a degree of separation. So ideally your investment banking front office is going to be somewhere different. Okay, for example, in Bombay also, their front office is sitting different location, back office is sitting different location. If you have commercial banking division and a securities division in one building also, it is going to be in different floor. Commercial banking people cannot go to securities business floor. There is also a concept of Chinese wall. Have you heard about this Chinese wall? If you work for any big organization, okay, they have a lot of these Chinese wall criteria. For example, you cannot enter into area where HR people sit because they have a lot of technical, personal information, salary related information, right? So restricted areas have been set, yes, within the bank so that people cannot enter into certain area where there is information, critical information. Okay, so these Chinese banks are being highlighted as a control so that information should remain in a particular area with only particular people. So also regulators, what they are doing is they are saying that okay, if you want to enter into three business in my state, you cannot do. Either enter into commercial banking or either enter into securities business, like that. So they will put restriction in that way that you cannot, they will not give license to operate into that business in a particular state in US. Okay, read this section. I hope everybody is good. Varun, Tejas, Shalini, Icha, Sai Srinivas. Now the interesting part. Okay, banking book and a trading book. Okay, now what generally banks do? Okay, trading book means they have a trading desk. Okay, so they will have trading desk for trading into swaps, then forward contract, futures contract, all of this, options basically. So you keep only those assets into trading book which you are going to hold for short period of time. Say for example, I have purchased bonds of some company and I know that I'm going to sell it after say around 6 months or after 3 months. So I'm going to hold that for that much period of time because I have an intention to sell. So I'm only engaging into this for trading. Okay. Banking book is somewhere where you create an asset which is going to be there for long period of time. So one of the asset is loan. When you create loan, yes, available for sale. That is the logic. Okay. Loan, it is going to stay with your bank for long period of time till the time the customer pays. Now the problem is what? Okay. Over here, because you are going to hold for a short period of time, the risk is generally very low. Over here, because you are going to hold the asset for longer period of time, the risk is generally high. So historically, okay, historically, what was happening? A lot of these banks, if there was an asset which was ideally supposed to be kept here in banking, they would keep over here. Why? Because the risk is low, so the capital requirement was also very low. इसको बोलते हैं, we call this as regulatory arbitrage. Because the rule is favorable over there, you are moving all your asset over there. Right? You are keeping most of the asset in the trading book because you are keeping low capital, because the risk is very low. Right? That was what happening. But now, after this crisis and all, there is a concept called FRTB. Have you heard of this? Fundamental Review of the Trading Book. Okay? In this, effectively what has happened, they have created rules that if you want to keep an asset in the trading book, you need to have a trading desk. If you have already figured out, if you already kept the asset in the banking book, you cannot move it to trading book. All of these, they have created a lot of rules and regulations related to it. So in level 2, you will find that. Okay. So what is banking book? So you keep your asset and liability which you are going to hold till maturity, long period of time. Okay. So generally your loans are kept like this, and you keep capital also on that. Obviously, because there is a risk. Now you are holding an asset, there is a risk. You have to keep capital calculation also. Okay. But when you talk about trading book, okay, you generally hold it for trading purpose. That is very short period of time. And these assets generally are traded in the market, so you know the price. So we do mark to market. What is mark to market? Pragna, Moksha, Hitesh, mark to market. Daily review. So we will calculate, we'll check the price of the asset every day and we'll see whether we are in profit or loss. Okay, we do valuation every single day. Okay, so because these assets are highly tradable, you have a market available for it and you can calculate daily mark to market. Okay, now generally the trading book would ideally have lower capital requirement as compared to banking book. Okay, so this was historically also very low. Now, in general, the default calculation for any financial institution is banking book. However, if a bank has a desk, what is a desk? Trading desk. Then they can put it into the trading book. In general, ideally it should go into banking book. But if they have a trading book, they can show that, okay, we are holding this asset only for a short period of time. I am going to put it in the trading book. Okay. And because of which you will have to keep low capital. Okay. Because of which you have to keep low capital. Answering to the query. So in banking book, asset valuation is also done frequently. It is done over a period of time, not every day. Because how will you do the valuation of loans? It is very difficult to do it every single day, no? Right? I'm taking a pause. Any query till this section? Apurva, I've answered your query. The next section, originate to distribute model. Okay. Have you heard of originate to hold? Originate to hold. And then you have originate to distribute. What is originate to hold? Suppose there is a homeowner who is buying a house and he is taking a loan from, say, FDFC. In India, it does not happen at that scale. In US, it happens at that scale. Okay. So if the loan is going to be kept in the books of FDFC only, then we call it as originate to hold. So I have originated a loan to keep it in my book. But under OTD, so there is Mr. A who wants to take a home loan. Okay. He goes to, say, for example, DHFL, which is a Divan Housing Finance Limited. It's a financing company. Okay, they have done the transaction. What he will do? He will pass on this loan, okay, into a pool of loans. and then on this pool of loan, we will sell a security. I'll show it to you in detail. That is called securitization. Yes. So what is this OTD model in detail? Okay, let us assume Citibank. Now Citibank has lot of loans. For example, auto loans, or for example, home loans. They have huge loans. Now certain loans they don't want to keep in their books. Okay, certain loans they want to. So what they can do is they can create a new entity called a special purpose vehicle. Okay, and they can pass on this entire pool, a pool of 10,000 home loans in US market. Okay, is it loan against security? No. You have to look at this example properly. Then only you'll understand. There is one more chapter, mortgage and mortgage-backed security, which will come later. This is entirely on the same concept. Okay. Now, so you have a pool of 10,000, and who is now the owner? Special purpose. So Citibank has sold this to special purpose. This special purpose vehicle is a Citibank's own company, separate company. Okay. Now what is happening? Okay. Special purpose vehicle basically is the owner of that pool, and special purpose vehicle has paid the entire dollar amount to Citibank. Now Citibank gets the money, they can issue new loans. They got the money now, they can issue new loans. Very simple. Now what a special purpose vehicle can do? Okay, they can go to lot of government entities in US to have government entities which help in securitization. Okay, and they can give this entire pool to them. Okay, they are government sponsored entities. Okay, and they will help you to create an MBS, mortgage backed security. Okay, now this MBS is sold, okay, to investors or their agent. It can be both. Now, who are my agents? See, if I am an investor, I invest in a mutual fund. Now these mutual funds can buy MBS, so they are my agent. I have put money into pension fund. I am an investor, right? But these pension funds can invest directly into these mortgage-backed securities, right? So they are my agents. Okay, either an investor can buy or an agent can buy these MBS product. Now what is going to happen when these home loans are going to pay EMI? Okay, these EMIs will first go to a servicer. Now, who is the servicer? A company who is going to help manage everything. Because you have 10,000 home loans now, it is not one or two, 10,000. You need a company in between, servicer. Okay, they will get the money, they will do the accounting, they will call up the homeowner and say, hey, you have not paid the EMI, all of that. Okay, and through this, it will go to the government sponsored entity, and through this, the investor will receive. Okay, through this, the investor will receive. Very basic concept. Now, the question, why would investor want to buy these MBS? See, first of all, during the crisis also, these MBS were giving good returns. Second, if I am an investor, I cannot directly enter into real estate market. But if I buy this MBS, I am able to take exposure on 10,000 homes. If I individually try to buy, I will only be able to buy 10-15 homes. But because of this instrument MBS, I have a exposure on this overall 10,000 pool that is there. If tomorrow the people in this pool start defaulting, they are not able to pay back their EMIs. What will happen? Those homes will be foreclosed and sold in the market, and when the money comes, it will be given to the investor. यहाँ तक सबको clear है? Everybody is okay? Is it similar to REITs? No, that is very different. Okay, so what happens in an OTD model? Okay, you are making loans, okay, and you are basically selling it to some third party. Okay, you are selling it to some third party. Okay, CLO and all, everything will come. I cannot explain this in this chapter. There's a mortgage-backed security chapter. In detail, it is going to come. That's a product, collateralized loan obligation. Okay. So you are going to create the pool and then you are going to sell it to the investor. And I talked about government sponsored entity. These are the entities which can help you, okay, to do the entire securitization activity. Okay, so they will create the pool for you if you want. They will also give insurance on the pool. Okay, if anybody defaults, then the government sponsored entity will pay. Like that. There are a lot of variations into it. Okay, so this first section is just to give you the overview, and that is what I have also given you. But what is the benefit of this OTD model? Now think, it increases liquidity. Now what is happening? See, home loans. It is an illiquid asset, no? You generally don't see market for selling and buying home loans. But because of the securitization, you have an opportunity to sell this. It has increased liquidity for that asset. What was that asset? Home loan. In the lending market, liquidity came. There is also one more reference to this. Now, because Citibank has got the money back, they have removed all the loans from their books and they have got the money back. So they can issue new loans. So new people will get loans. Whatever. So it is more about the liquidity into the market. Okay. In case of recovery, who will have the responsibility? Servicer will call you, no? He is also getting some money. Okay. Now the model, see, we had an example of 10,000 home loans. But suppose we don't take home loans. We can also take student loans. We can also take credit card, auto loan, all of these. Any asset which is giving cash flow, we can create that. Okay. Now for bank, Citibank, when it is removing all the asset from its book, it is freeing up capital. Why? See, Citibank had 10,000 home loans on its book if they wanted to remove. If they do not remove, they will have to keep capital, no? Because it's risk. If they remove, okay, first of all, they are getting the cash and they are also not required to keep capital. They can use that new money to give new loans. Okay, taking a pause. Read the first two paragraphs. These types of products are there now. Yes, there are. We do see securitization does happen. What is the problem with this model? It has led bank to lose lending. Why? Lending standard. So in 2007 crisis, what happened? Because everybody was involved in securitization, the Citibank, for example, who was giving initial loans, they realized that I just need to give loans, get them, and create a pool. So I will start reducing my lending standard. It simply means previously I was checking 10 things before giving loans. Now I am only going to check 3 things. So it reduced, a lot of banks, they started reducing lending standards, and because of which a lot of subprime customers got loans. What is subprime customers? Those customers who do not have money, do not have job, do not have any income, they also got loans. And because of which this created a housing bubble and there was a crisis. Ninja borrowers, yes. Read this last section and then we'll go to the question. What is the first question? The minimum level of capital needed to maintain according to its own estimate, own model, own risk assessment. What is that answer? Meenal, Nishant, Pratik. What is your answer for the first question? Read. My own estimate, bank's own estimate. It has to be economic capital. Economic capital. Which of the following, second question, which of the following action in the banking system is most likely intended to address the problem of moral hazard? How do we solve moral hazard? We talked about moral hazard in terms of insurance, and insurance companies are going to do what? Risk-based premium. Answer is A. See, if you increase loans, obviously it is wrong. Government implement, because this is already there. Bank increase interest rate, they offer to deposit. It will not solve the problem, no? If investment bank is most likely to earn a trading profit from buying and selling securities, it should arrange what? See, I am earning a trading profit. This is nothing but your firm commitment. How come? I am going to tell you that, okay, I'll buy all the shares from you and I'm going to sell. It is not best effort. Best effort, I am going to make a fees. But I am going to make a profit. Profit will only come in your firm commitment. What is the purpose of Chinese wall? What is the purpose? Fourth one. Is it to restrict companies engaging into these? No, these activities. Okay, restrict companies from offering both products? Wrong. Prevent a bank failure? Wrong. Prevent from sharing critical information. Fifth one. What is the drawback of the OTT model as per the book? Did they tighten the standards? No, no. They in fact loosen the standards. Answer is C. So with this, we have completed the chapter.